For more than a century, every major financial collapse has followed the same silent choreography: a euphoric peak, a subtle crack, a deceptive rebound, a grinding bleed-out, and finally a full-scale capitulation that wipes out an entire generation's wealth. Economists call it a cycle. Historians call it inevitability. But in truth, it is a pattern, a mathematical recurrence so precise that once the signals appear, the trajectory becomes almost impossible to avoid. This is what analysts refer to as Stage 5, the terminal phase of every great bubble. It is the point where prices no longer respond to fundamentals, where optimism overrides caution, where leverage becomes the dominant force in the market, and where the first tremors of collapse are visible only to those who understand how cycles actually break. In Stage 5, everything looks perfect, and that is exactly why it is so dangerous. The terrifying part isn't that this has happened before. The terrifying part is that it always happens the same way. The South Sea Bubble of 1720, the railroad mania of the 1840s, the Panic of 1907, the Wall Street crash of 1929, the dot-com implosion of 2000, the housing catastrophe of 2008, each one followed the same chronological blueprint, and each one took roughly 18 months from the first unmistakable crack to the point where the vast majority of wealth had been destroyed. We are now standing in that same moment again. The indicators that preceded the 1929 collapse have reappeared almost identically in 2025. Record insider selling, unsustainable valuations, historic margin exposure, and a level of investor euphoria characteristic only of the final, most fragile phase of a bubble. Most people don't recognize Stage 5 until it is already too late, but the pattern is here, and the countdown has already begun. Stage 5 is not chaos. It is structure and engineered repeating architecture that reveals itself long before the public realizes anything is wrong. And the most astonishing fact about the current moment is this: every structural marker of late-stage excess that defined 1929 is present again in 2025 in nearly identical form. Begin with insider behavior, the most reliable tell of approaching collapse. In 1929, corporate executives were quietly liquidating enormous positions months before the public crash. The same phenomenon is happening now. Insider selling in 2025 is at the highest level since 2007, with executives unloading shares at a ratio exceeding 20-1 compared to insider buying. People with the deepest visibility into earnings, balance sheets, and forward guidance are exiting, while retail investors continue piling in. Next is margin debt, the accelerant of every market inferno. In September 1929, margin debt reached roughly 8% of U.S. GDP, a level so extreme that even a 10% decline in stocks could trigger mass liquidation. Today, margin balances are hovering around 7.9% of GDP, an almost perfect mirror of the conditions that preceded the 1929 meltdown. High leverage turns normal volatility into forced selling, and forced selling into systemic cascades. Then come valuations, perhaps the most ignored but unforgiving signal. The Shiller P/E ratio in 1929 peaked at 33, a level then considered absurdly inflated. Today it sits near 35, higher than the valuation at the doorstep of the Great Depression, surpassed only during the dot-com mania. Prices have outrun earnings by such magnitude that any economic slowdown will force a violent repricing. And beneath it all lies the deepest warning, the divergence between market optimism and economic reality. In 1929, corporate earnings had already peaked months before stocks reached their highs. In 2025, Q3 earnings have flattened, guidance is being cut across sectors, and CEOs are warning of tightening conditions. Yet markets continue rising as if immune to gravity. The anatomy is the same, the signals are the same, and the consequences, if history repeats, will be the same. Every collapse has a birthday, a precise moment, quiet and uncelebrated, when the last breath of a bull market is drawn and the countdown truly begins. For the Great Depression, that moment was September 3rd, 1929. For us, it is November 2025. In September 1929, the Dow reached its all-time high of 381.17. Newspapers celebrated the achievement. Analysts proclaimed a new era of prosperity. Prominent economists insisted the market had reached a permanently high plateau. The optimism was absolute and absolutely wrong. What almost no one realized was that the fundamentals had already turned. Industrial production had softened, commodity prices were weakening, and leading indicators were rolling over. But the market continued rising because markets at their peaks run on belief, not data, and that is exactly where we stand today. In November 2025, U.S. markets hover near or at record highs. Retail investors are confident. Financial media insists that artificial intelligence, technological innovation, and monetary policy have eliminated the old cycles. Yet underneath this surface of celebration, the structural cracks are unmistakable. Corporate earnings peaked 2 quarters ago. Revenue growth is slowing across multiple sectors. Profit margins, the lifeblood of valuations, are contracting as borrowing costs remain elevated. The divergence is identical. In 1929, fundamentals fell while prices rose. In 2025, fundamentals are softening while prices reach euphoric extremes. Another parallel smart money exit timing. Joseph Kennedy, Bernard Baruch, and European banks sold heavily throughout mid-1929. Today, the modern equivalents, insider executives, major institutions, and some of the world's most disciplined allocators have been reducing exposure quietly all year. Warren Buffett's cash position is at a historic peak. Hedge funds' net exposure is the lowest since 2008. The market peak in both timelines felt safe. Both peaks hid the same fragility, and both marked the beginning of an 18-month descent. The public calls it a crash, but historians, economists, and market architects know the truth. The first violent drop is not the collapse. It is the crack, the moment when leverage, not fear, begins to unwind. The moment the system exhales after years of artificial expansion, the moment the countdown becomes irreversible. In October 1929, the crack began with subtle tremors. Trading volumes spiked. Price swings widened. Professional traders recognized the signature immediately: distribution. Smart money selling to eager late-cycle buyers. Then came Friday, October 18th, a sudden sharp decline. Not fatal, but unnerving. On Monday and Tuesday, more selling. By Wednesday, panic was forming around the edges. And then the bankers stepped in. On October 24th, Thomas Lamont and other titans of finance declared they would support the market. They bought stocks publicly to restore confidence. Newspapers celebrated the intervention. Analysts urged calm. For a moment it worked, but over the weekend, tens of thousands of margin calls arrived by mail. And Monday, October 28th, the market fell 13%. Tuesday, October 29th, Black Tuesday, it fell another 12%. This was the crack, not the end, the beginning. Now look at December 2025. The setup is eerily similar. Trading volume is heavy. Volatility is rising. Hedge funds are hedging aggressively. Regional banks are wobbling. Corporate earnings disappointments are piling up. And beneath it all lies the most dangerous force in modern markets: historic leverage. Margin debt is brushing against the same 8% of GDP threshold that preceded the 1929 crack. It won't take a catastrophic event to trigger the break. It could be a missed earnings report, a bank announcing unexpected losses, a geopolitical flashpoint, or simply a week of concentrated selling. When the crack comes, markets will fall 10 to 15% rapidly. Then just like 1929, institutions will attempt a rescue, central banks will speak, liquidity facilities will be announced, analysts will call it a healthy correction. But the math does not lie. Once leverage begins to unwind, the cascade cannot be stopped. The crack is not the collapse, but it guarantees one. After the first violent break, the world does something predictable and fatal. It breathes a sigh of relief. This is the phase historians call the dead cat bounce, but in human terms, it is the phase of false salvation. It is the moment when people convince themselves that the worst is over, precisely because they cannot emotionally process the idea that the worst is yet to come. In November and December 1929, right after the infamous Black Monday and Black Tuesday, something astonishing happened. The market stopped falling. Prices stabilized. Some days even saw strong gains. Newspapers declared the panic contained. Economists insisted the fundamentals were intact. Advisors told clients this was the buying opportunity of a lifetime. People believed it. They bought the dip. They averaged down. They reassured themselves that America was too strong to fall, but beneath the surface, the machinery of collapse was already grinding forward. Banks were absorbing losses quietly. Borrowers who had bought stocks on margin couldn't repay their loans. Businesses were cutting production. Corporate earnings were deteriorating. Credit was tightening. Everything that destroys markets was already happening but invisible to the public eye. And now look at January 2026. The parallel is exact. After the December 2025 crack, there will almost certainly be a rebound, a 10% surge. A wave of optimistic headlines. Analysts calling the bottom. Retail investors rushing back in. But this bounce is a trap, the most expensive psychological illusion in financial history. Because while the surface looks calm, the structural damage is spreading. Regional banks under stress, commercial real estate defaults, accelerating corporate layoffs beginning, and liquidity slowly evaporating from the system. The dead cat bounce doesn't save investors. It lures them back in so the collapse can take everything that's left. If the crack is violent and the dead cat bounce is deceptive, then the next phase is something far more cruel, a slow-motion disaster so grinding, so relentless, that it breaks people not with shock, but with exhaustion. From January to June 1930, the market did not crash. It bled. Month after month, small declines interrupted by brief hopeful rallies that faded almost immediately. This was not the drama of Black Tuesday. This was psychological warfare. Investors didn't lose everything in a single moment. They lost it inch by inch, week by week, as hope eroded and the real economy began to collapse under the weight of tightening credit. Factory orders fell. Industrial production collapsed by 20%. Exports dried up. Businesses laid off workers quietly at first, then aggressively. Unemployment climbed from 3% to nearly 9% in 6 months, a seismic shift for a society that had convinced itself everything was fine. Meanwhile, more than 600 banks failed during this period. No headlines, no shockwaves, just steady, silent destruction. This is exactly what February to July 2026 is poised to look like. Once the 2025 crack and 2026 bounce pass, the market will begin its long descent. Not a cliff, a staircase downward, a 3% drop here, a 5% miss on earnings there, a regional bank quietly shuttering, a major corporation announcing 8,000 layoffs, commercial real estate defaults hitting new highs, consumer debt delinquencies accelerating. The news cycle will slowly turn pessimistic. Confidence surveys will weaken. Politicians will assure the public that the fundamentals remain solid. But liquidity, the lifeblood of modern markets, will be evaporating. Retail investors will hold reassuring themselves it's temporary. Funds will rebalance, but not enough to matter. Analysts will insist recovery is around the corner. Meanwhile, the decline will continue methodical and indifferent. By mid-2026, markets may already be down 40% to 50% from their peak. The grind phase is where optimism dies, not in a single blow, but in 1,000 small cuts. By mid-1930, the slow-motion bleed transformed into something far more dangerous, a systemic fracture spreading through every layer of the economy, not suddenly, not explosively, but in a cold, predictable sequence. Economists later called it the cascading failure phase, the moment when isolated weaknesses begin linking together into a national and eventually global breakdown. Bank failures were the first domino, not the giant Wall Street firms. Those survived longer because they had political connections and deeper reserves. The casualties were the regional and community banks, the institutions holding the mortgages of farmers, the savings of shopkeepers, the deposits of small towns. Between January and December 1930, over 1,000 banks collapsed. Each failure annihilated local credit systems, wiped out personal savings, and triggered fear among depositors everywhere else. Without FDIC insurance, a bank failure meant total loss. So people began withdrawing cash out of fear. That fear created more failures. It was a loop no one could stop. Businesses deprived of credit could no longer operate. Factories reduced shifts. Retailers slashed inventory. Small businesses closed their doors permanently. Unemployment rose from 9% to 15%. Entire industries contracted. Consumption plunged, triggering another cycle of layoffs. The economic engine seized quietly, steadily, fatally. Now overlay this with 2026. In February, July 2026, the same cascading pattern begins to reappear. Commercial real estate defaults will surge as office towers lose tenants. Banks heavy in CRE exposure, especially regional lenders, will absorb huge losses. Several will fail despite rescue attempts. Credit conditions will tighten nationwide. Corporations will slash hiring. Then jobs, earnings will collapse quarter after quarter. Consumer spending will weaken under high interest burdens. Defaults on auto loans, credit cards, and mortgages will rise. Liquidity in financial markets will thin dramatically. Each failure compounds the next. Each tightening triggers more tightening. Each loss creates another. This is the stage where denial becomes impossible, yet help remains ineffective. Central banks will cut rates. Government officials will appear on television reassuring the public. But the structural damage will already be too deep. Credit contraction, once triggered, feeds on itself. This is the moment the economic machine transitions from recession into collapse. By the summer of 1930, the market was no longer bleeding, it was breaking. The slow-motion deterioration that characterized the first half of the year gave way to something sharper, more violent, and far more psychologically devastating capitulation. This is the moment when investors no longer sell because they want to, they sell because they must. From July to December 1930, the Dow's behavior changed dramatically. Declines were no longer measured in modest percentages. They came in cascading waves. July 15%, August and 12%, September 18%, November another brutal collapse. There was no bad news catalyst, no single headline, no global shock. The selling fed on itself because capitulation is not driven by information, it is driven by exhaustion. Investors who had held through 9 months of grinding losses finally broke. Mutual funds desperate to meet redemptions dumped holdings. Banks liquidated whatever assets they could sell. Insurance companies sold to maintain solvency ratios. Panic sellers overwhelmed every bid. When everyone needs cash at the same time, prices fall until anyone is willing to buy, and in capitulation that someone disappears. This same dynamic will define August 2026 to February 2027. By this phase, The market will be down 50-55% from the peak. Unemployment will likely exceed 10-12%. Corporate bankruptcies will accelerate. Regional banks may fail in clusters. Credit markets will freeze. Consumer sentiment will hit multi-decade lows. Retail investors will abandon the market entirely. Institutions will sell because regulations force them to. Individuals will sell because they cannot endure more loss. Funds will sell because withdrawals leave them no choice. And in this environment, selling pressure becomes a chain reaction. This is the point where even strong companies trade at absurd discounts, where decade-long bull market gains evaporate, where wealth that took 30 years to build disappears in 30 weeks. Capitulation is not just a financial event. It is an emotional breaking point, the moment when hope collapses and survival becomes the only instinct left. 18 months. That is the rhythm history obeys, not because of superstition, but because of mathematics. Leverage takes time to unwind. Credit takes time to contract. Households take time to break. Businesses take time to fail. And markets take time to accept reality. For the Great Depression, that moment came in March 1931, exactly 18 months after the September 1929 peak. The Dow had fallen from 381 to 160, a 58% decline. But more importantly, the wealth destruction was already complete. Middle-class households had been wiped out. Retirement savings were gone. Bank failures had ravaged entire towns. Businesses had collapsed by the tens of thousands. The headlines would warn of further drops, but the financial lives of ordinary people had already been erased. And yet the bottom had not arrived. It would take 2 more years for the Dow to reach 41 and 89% total loss, but by the 18-month mark the transfer was finished. What disappeared from retail investors did not vanish. It changed hands. Who bought during the catastrophe Joseph Kennedy flush with cash after exiting early? Bernard Baruch, who had liquidated before anyone else realized danger. The Rockefellers who accumulated assets at fire sale prices, old money families and institutions who were positioned patient and liquid. They weren't geniuses. They just understood the pattern. Now overlay that with the modern timeline. 18 months from November 2025 brings us to March 2027, the same point in the cycle. Markets likely down 60-70%. Corporate defaults accelerating. Unemployment sharply elevated, consumer wealth devastated, banks under intense stress, government interventions exhausted or ineffective. But beneath the panic, something else will be happening. Quietly accumulation, the same mechanism that created generational wealth in 1931 will reactivate. Cash-rich institutions will begin buying. Strong companies will trade at absurd discounts. Assets will be redistributed, not destroyed. The 18-month mark is not the end of the collapse. It is the end of denial and the beginning of the greatest wealth transfer of the century. When a bubble reaches stage 5, when the crack appears, when the dead cat bounce fades, when the grind becomes intolerable, and when capitulation breaks the collective psychology of the market, everything feels hopeless. Yet history tells us that it is precisely in these moments of despair that the blueprint for survival and even prosperity becomes clearest. The mistake most investors make is believing the crash happens in a single moment. It doesn't. Crashes are sequences, and because they follow a pattern, they can be navigated with discipline. The playbook has 4 phases, the same one used by those who emerged from previous collapses not ruined, but enriched. Phase 1, before the crack. Navdek 2025. This is the final window to reduce exposure, not panic selling strategic de-risking. Raise cash. Exit speculative positions. Protect capital before leverage unwinds. Once forced selling begins, the opportunity is gone. Phase 2, the false hope. Jan-Feb 2026. The rally after the initial crash is a trap. It is designed by market psychology to pull the last buyers in. Do not chase it. Use it to finish positioning defensively. The decline that follows is inevitable and much deeper. Phase 3, the grind down. Jewel, 2026. This is the hardest phase emotionally. Markets drift lower for months. Earnings collapse, layoffs accelerate, banks tighten credit. Most people panic here. The correct move is patience, wait, preserve liquidity, avoid impulsive buying. Phase 4, the capitulation opportunity. AUG 2026, MAR 2027. This is where fortunes are made. When markets fall 60-70%, when fear is total, when the news cycle predicts endless doom, that is when assets trade below intrinsic value. Scaling in slowly, deliberately into resilient companies and essential sectors is how generational wealth is built. Cycles destroy the impatient. They reward the prepared. History does not repeat word for word, but it rhymes with frightening precision. And the rhyme is already playing.